Look at this split screen. On the left is the back-tested equity curve of a mathematically verified trading model. It's a smooth, ascending path to profitability. On the right is the exact same model, executed in real time by a human being, erratic, volatile, and plagued by deep drawdowns. The underlying math hasn't changed, and the market conditions fall entirely within the back-tested parameters. Yet the profitable system breaks down the moment a person actually starts pushing the buttons. Standard industry advice for closing this execution gap focuses on willpower. Traders are told to eliminate their emotions, rely purely on mental discipline, and simply stick to the plan. This advice ignores the basic architecture of the human brain. Suppressing emotional response is physically impossible for a functioning nervous system. Achieving consistency in the markets requires a different approach, overriding our evolutionary hardware. We have to bypass our innate wiring through deliberate physiological regulation and rigid mathematical architecture. In quantitative trading, discipline functions as a structural defense mechanism, shielding the execution process from biological interference. To understand why we fail under pressure, we look to behavioral economist Daniel Kahneman. He established that the brain operates on two distinct cognitive systems. System 2 is slow, deliberate, and capable of probabilistic logic. This is the analytical engine required for successful quantitative trading. System 1 is fast, emotional, and reactive, optimized over millennia for immediate survival and pattern recognition. Sudden market volatility and financial risk bypass our logical processing entirely. A collapsing price chart directly targets and activates System 1. Functional MRI studies tracking neurological reactions to financial wins and drawdowns show that during these moments, the limbic system, the emotional center of the brain, seizes control. This takeover is chemical. When a trader faces intense market turbulence, the brain releases a severe spike of cortisol. That cortisol spike forces the brain to abandon statistical reasoning and rely on evolutionary shortcuts, known as heuristics, to make split-second survival choices. Execution errors during market stress represent a hardwired biological response to perceived danger, occurring independently of a trader's willpower. Under stress, the brain assumes that a small sample size of recent random events accurately reflects the full long-term probability distribution of the market. This specific error in pattern recognition splinters into two distinct, highly destructive trading biases. The first is the hot hand fallacy, the unwarranted extrapolation of past trends based on a small winning streak. A trader experiencing this fallacy aggressively increases their position size, treating a winning continuation as a certainty rather than a statistical probability. The opposing bias is the gambler's fallacy, which overweights the probability of an event simply because it hasn't occurred recently. Here, the trader closes a winning position prematurely or averages down on a loser, operating on the flawed assumption that a market reversal is due. Both biases occur because the brain misinterprets independent, unrelated events, like consecutive coin flips, as a connected, predictable sequence. By forcing the trader to substitute mathematical logic with evolutionary pattern matching, both fallacies actively destroy a system's positive expected value. Practitioners must first physically regulate their nervous system before they can address their trading strategy. The biological reality is that you cannot outthink or rationalize your way out of an active cortisol spike. High-performance professionals use mindfulness and tactical breathing as clinical circuit breakers to physically reset the nervous system and regain cognitive control. Box breathing follows a precise mechanic: inhaling for 4 seconds, holding for 4, exhaling for 4, and holding for 4. Maintaining this rhythm during high-stress market events lowers cortisol levels by 35%. By inhibiting the stress response in this way, practitioners see a 42% decrease in impulsive trading decisions as the brain maintains access to logical processing centers. Regulating the physical body is the mandatory first step to forcing the brain out of System 1 panic and back into System 2 logic. Physiological regulation prepares the mind, but structural mathematics secures the actual execution. The critical mechanism is dynamic position sizing, which translates abstract risk tolerance into a concrete, unyielding mathematical constraint. This formula governs the size of every trade. Position size equals account size multiplied by risk percentage divided by the difference between entry price and stop-loss price. The numerator contains the fixed variables, your total account size, and a strict maximum risk percentage, typically 1 or 2%. The denominator holds the variable market inputs, the entry price and the stop-loss price, which fluctuate based on current market volatility. As market conditions widen or tighten the required stop-loss distance, the position size output automatically adjusts in inverse proportion. This provides a mathematical guarantee. Regardless of volatility, the total dollar amount at risk remains completely static. This math has a profound effect on psychology. By ensuring the dollar risk never fluctuates, the trader eliminates the primary trigger that causes limbic panic. Mathematical position sizing enforces the exact discipline that the human brain cannot maintain through willpower alone. Professional traders stop attempting to achieve an impossible state of market neutrality or emotional numbness. Instead, biological impulses like fear and greed are recategorized as data signals within an engineered response. This transition from amateur to professional is a process of systematic deconditioning, replacing gut-level reactions with the rigid two-step process of physiological regulation and structural math. Professional discipline in quantitative trading relies on an engineered mathematical system that operates regardless of the trader's emotional state.